Good morning, everybody. It's a good time to have a bit of a break for some coffee because we'll be going over an accounting update. So you'll need the caffeine. I'm Matthew Burke. I'm a partner with Cerini and Associates. Between Ken and I, we pretty much cover every nonprofit in the office that we work with, and that's 100 to 200 at this point in time. So, like I said, what we're going through today is an update of different accounting standards that have changed recently and that will change in the future that affect everybody, and some specifically that only affect nonprofits. So everybody in this room should be able to get something out of this conversation we're about to have. If you have any questions, feel free to interrupt. I'll try to answer them as best I can. If I can't, because we're really trying to boil down thousands of pages of gobbledygook into a half hour, if I can't answer them, I have a guy with a laptop over there who can provide some answers. His name is Sean. So we'll start with an outline of here what we're really trying to accomplish in the next half hour. One, you should really understand what GAAP is. If there's any finance or accounting professionals in the room here today, you should already know what that is, but I'll refresh it. What is the FASB? What's the standard setting process, since we're talking about different changes that have taken place? And then we'll discuss some of those changes in chronological order. Just in case we run out of time at the end, it'll probably be for something that we're not going to have to deal with for 5 years. Some other notable standards and some helpful hints to bring this all home. First, we'll start, what is GAAP? Accountants love acronyms. So GAAP, I'll be defining a bunch of these things as we go through. GAAP is generally accepted accounting principles. Here, we're talking about the United States of America. There's whole international standards that we're not going to be worrying about. GAAP is the accrual basis of accounting. So accrual basis recognizes revenues when earned, when you have a right to the assets there, recognizes expenses when incurred, and it's really the opposite of a cash basis, which recognizes revenue and expense when money is received or spent, respectively. Why GAAP? Why accrual? It's assumed to be a very accurate depiction of an organization or an entity's financial performance for any given period of time, or at any point in time when we're talking about balance sheets. And GAAP is generally required by different funding sources, other regulatory authorities that you may deal with. I know if you submit vouchers, they're generally on the GAAP basis. CFRs, New York State Charities Bureau, everybody likes to see GAAP. When you deal with banks and lenders, they like to see GAAP. There are, of course, exceptions. There are exceptions to everything. Claiming schedules on CFRs, for instance, can be on the cash basis, and the Charities Bureau for New York State really will accept most anything that's sent to them. I don't think they even look at what you sent to them, but I digress. So what's the FASB? Another acronym. It's the Financial Accounting Standards Board. Well, what's the Financial Accounting Standards Board? It was established in 1973. It's a nonprofit independent organization consisting of different board members that were accountants in their past lives. They're either working at big publicly traded companies or for big four accounting firms, or from the investor side. So it's meant to bring together a bunch of different people from different disciplines to set the standards for the accounting world that affect the US. The SEC, the Securities and Exchange Commission, handles publicly traded companies, probably doesn't apply to anybody here, but they have designated the FASB as their standard setter. The different state boards of accountancy, the New York State and so on, AICPA, the American Institute of CPAs, again, acronyms, they all have recognized FASB as the authoritative standard setter for the accounting principles that companies have to follow. And the mission here, it's ripped right off their website. It's to establish and improve financial accounting and reporting standards to provide useful information to investors and other users of financial reports. So what we'll get into now are different changes really in the vein of this mission. They're trying to always get better. Better doesn't always mean better, though. They change things around. It can be complicated. It can be timely, cost-sensitive. A lot of things come into play when the FASB starts changing things. So here's the process of what they do, and we'll breeze right through these. So the board identifies different financial reporting issues. They get recommendations from the public, from stakeholders, from people in practice, from nonprofits like yourselves. They decide whether a project is important enough and relevant enough to add to its technical agenda. I throw that in quotes. You wanted to see what their technical agenda was, go to their website and drink more coffee. The board deliberates at one or more public meetings, the various reporting issues identified and analyzed. So they make this a public process, supposedly. They get comment letters from CPA firms like ourselves, from other individuals, and they have roundtables, they have discussions to really find out if changes need to take place, and if they do, what they should do to make these changes. Exposure drafts, the preliminary standards setting changes are issued. They get more public feedback on that. Eventually, at the end of this, we get to the bottom where they issue an accounting standards update, ASU. You're going to see that a lot in the next 20 or so slides, amending the accounting standards codification. The dictionary, encyclopedia, Bible, Torah, whatever, for accounting knowledge is in this accounting standards codification. So we'll start with the updates that have already taken effect and that you may or may not be aware of. Hopefully you're aware of it. If you're a client of ours, you should be aware of it. If you're not a client of ours, you should be a client of ours, and we'll make you aware of it. So these have already gone into effect. The first one deals with debt issuance costs, and the second one deals with cloud computing. So it kind of ties in nicely with what you just sat through. It's just not as scary. So debt costs. When you seek debt financing and you incur different legal fees, underwriting costs, things like that, in the past, those costs have been capitalized as an asset on your balance sheet and amortized over time to interest expense. This change really isn't that monumental. There's no net impact. What FASB wants you to do with this ASU is to, instead of capitalizing that as an asset, reduce the related liability by the value of all those costs. So if you have underwriting costs of $100,000 in the past, it would be sitting up on your balance sheet as some sort of either current or long-term asset. Now it's just going to reduce the debt. And you'll probably disclose that in the financial statements, the back, the supplemental areas, to explain that the debt has been reduced by these capitalized debt financing costs. These adjustments must be applied retrospectively. I put that in caps, meaning past presentations have to be restated for this. Again, it's not that big a deal. It shouldn't be that hard, but it does create required disclosures, additional paragraphs in the back of your financial statements explaining why you made the change, what the change impacted on past presentations, and how much the change really accounted for. There's a proposed ASU out there that obviously hasn't taken effect yet, and hopefully it never does, because it would have some negative ramifications on a lot of people sitting in this room. It would change the classification system for current versus long-term debt. This will come up again later, but current debt or assets are those that are either liquidated or become cash within a 1-year period of time. Non-current long-term is greater than 1 year period of time. So obviously you want more current assets, you want less current debt. The proposed standard would make it such that you probably have more short-term debt on your balance sheet, especially if you have an instrument that's being refinanced after year-end. I'll give you an example. Say you have a mortgage with a balloon payment that comes due a month after year-end. Your year-end is 12/31/16, comes due in January. If you refinance that on January 15th before it comes due, under the current standards, you could make that whole thing or most of that a long-term debt because we know as your auditors that you refinanced that. Under the new proposed standards, you wouldn't be able to call that a long-term debt. It would still show up as current on your balance sheet. So it could theoretically sink your balance sheet, make your liquidity measures bad for your banks and your lenders and your donors and whoever else is looking at you. So it's only proposed. It's many years away, but hopefully it gets fought hard enough so it doesn't become a reality. The next one, software costs. Software is a difficult issue for accountants because one, we're geeks, and two, we're not tech geeks. So it's hard to understand a lot of what's happening in the James Rocker Nerds That Care cybersecurity scary world that we just talked about. But the FASB is trying to get back into the 21st century with the rest of the world, and they're issuing new guidance and new standards for how to account for software that really isn't a cloud-based software as a solution type model, which is different than it was in the past. 20 years ago, you buy software, you get a disk in the mail, you install it, and that disk either lasts forever or it's got some license period. Now it's a little bit more amorphous. It's harder to figure out how these cloud computing arrangements work. A lot of you probably have cloud-based software without even realizing it now, whether it's your fundraising software, your membership management software, even your accounting software. When you deal with QuickBooks Online or Xero or NetSuite, they don't reside on your physical servers anymore. They're up in outer space, wherever the cloud lives. I'm not sure. So FASB has made some changes to make it clearer, but it's still very muddy, as to how to account for these software licenses that may be buried and embedded in these cloud arrangements. What I would tell you guys from a practical standpoint, if you have anything like this, you should run it past your accountants. You have to carefully review your contracts to see if there are any licenses in there, because licenses with a long-term benefit are carried as assets on your balance sheet. If they're not carried as assets, they're going to be an expense, like a maintenance type contract, something like that. And the lines are blurry. It's hard to really understand this. And something I'll say throughout this, most of your organizations are probably audited. If you have any questions about this kind of thing as you're going through, ask your auditors what their opinions are. Share with them the different information that's available so they can help you make a determination as to how to account for this. But these adjustments can be applied prospectively, meaning going forward. If you have any cloud-based software, just look at your contracts, talk to your accountants. There will be additional disclosures that take place for the change in accounting principle change if you do have to implement these changes to the current accounting that you've done. So these next few updates affect 12/31/17 and June 30/18 year-end entities. Really, the language they use is effective for financial statements issued for fiscal years beginning after December 26th. So even in telling you the dates where these things take effect, they make it complicated. But in a sense, the years we're living in now, whether you're 12/31 year-end or you're like a June year-end or an April, it affects you now. These are the things that you should be focusing on now. First one deals with going concerns, second, inventory, and the third, consolidating for-profit limited partnerships and companies into a nonprofit organization. So we'll walk through each of these. First one, going concern. Hopefully none of you are familiar with this scary language. It's really the worst thing that an auditor or an accountant can ascribe to your financial statements. In this case, the word concern means a business or an operating entity, a firm. It's a noun. It's not like I'm worried, concerned. So financial statements are prepared always assuming that your entity will continue as a going concern, as a continuing business. And in the past, auditors had to make assessments as to whether or not they thought there was, quote, substantial doubt about your ability to continue as that going concern. Now the new standards are placing more impetus on management to make those determinations. So management has to assess its own ability to continue as a going concern. And the standard got a little bit stricter, unfortunately. So the new standard applies this responsibility to a one-year period of time from the financial statement issuance date. So again, let's say you're a December 31st year end and your year ends December 31st, 2016. And it looks like you're gonna have a bad year. Your ratios are in poor condition. You had losses. Doesn't look too good. The old trick that auditors would do would say, okay, well, we have to look at this and objectively analyze whether or not we think you will be around in a year. If the numbers say you're not going to be around in a year, well, we can just wait a year and issue the audit, and we know you're still here. Clean opinion, no going concern. Can't do that anymore because the new standard says from the date that the audit is issued, you have to be around for a year to avoid that going concern scary language. In the past, it was based on the balance sheet date. So 12/31/16, as long as we knew you got through 12/31/17, we could issue a clean opinion. Can't do that anymore. So they took that little trick out of our bag of tricks, which is getting smaller and smaller. Disclosures are required if management concludes that it is, quote, probable that the entity will not meet its financial obligations during the one-year period. So here it becomes important to look at your liquidity measures, your working capital, current assets minus current liabilities. What are your total net assets for the year? Are they negative? Are they positive? Are you trending down? There's qualitative factors. Did you lose key funding sources? Are you getting sued? Is there something else that's going on that factors into whether or not you'll be able to be in existence for a continued year? There's additional disclosures if management determines that, one, it's probable we can't be around for a year, and two, we don't really have great plans to get us through this next year. Because the other aspect of the audit report that we used to issue was, what are management's plans? Financials may look poor in condition on the surface, but if you dig beneath and you see management has received new funding or whatever else takes place after you're in, you could kind of overcome that doubt. It makes it harder now to overcome that doubt, unfortunately. And they define substantial doubt here if it's probable that the entity will be unable to meet its obligations as they become due within 1 year after the date the financial statements are issued or available to be issued. So for us as auditors, this is really one of the touchiest subjects we ever have to deal with because we have an obligation to be independent. But on the other hand, we do want to see our clients succeed and we don't want to give them going concern opinions because it can become what I put here, a self-fulfilling prophecy. Banks see that, donors see that, they automatically assume you're going out of business in the next year and they walk away. So this hopefully doesn't apply to anybody here. If it does, take it very seriously. Make sure if you do have a poor financial condition, you're underwater in any sense, make sure you have good plans in place and that you can pass those by your auditor to make sure that they don't have to give that scary going concern other matters paragraph in the opinion. You want to avoid that at all costs. Early adoption of this standard is permitted, but I don't know why anyone would want to do that. This next one may not affect many organizations here. Inventory, I know some museums may run gift shops or some organizations have thrift shops, things like that. Here it affects entities using the FIFO or average cost measurement principles, doesn't affect those using LIFO. Inventory is generally now carried at the lower of cost or market. So if I buy something for $100, I sell it for $200, it's on my balance sheet for $100. Cost is lower than market. If, however, I buy something for $100 and now it's worth 50, I have to write it down to that 50. So this inventory ASU makes it a bit easier. It simplifies the standard. The previous standard interpreted that market, lower of course the market, as replacement cost. So what would it cost me to buy this new piece of inventory today, less other pluses and minuses? New standard really is just the net realizable value, which is generally the sales price less any expected costs. So if this applies to you, it should help you a little bit. It sounds more complicated than it really is. And I think most organizations carry everything the way it should now at cost, and the value doesn't always dip below. It doesn't become impaired to the point where you really have to consider this. But again, if you do have to adopt this, you're required to disclose the nature and reason for the change in principle in the first year where you adopt it. There's another proposed standards update out there that would add additional disclosures to inventory. Early adoption is permitted here also. Yes?
Does that apply to other items, other assets outside of inventory, say real estate?
It depends on if real estate is inventory for you. If it's an organization that deals in real estate, it could. If not, if you're just holding real estate, then no, this standard doesn't specifically apply to that. Assets held for resale is a whole other section of the codification. The next one gets a bit complicated. So we've been seeing in recent years as an accounting firm, as we've elevated and picked up bigger clients that do more interesting transactions, there's a structure in place where a nonprofit can own, it seems kind of counterintuitive, but a nonprofit can own part of or entirety of a for-profit entity. And what we've been seeing lately, especially in the housing world, HUD type arrangements, is the nonprofit will own a very nominal share, let's say 0.1, 0.01% of a for-profit limited liability company or partnership, so LLC, LLP, more acronyms. And there were questions as to whether or not the nonprofit should consolidate that for-profit entity into its own books. Well, this ASU is actually very helpful because it fills in a layer of gap that really wasn't very clear in the past. So this makes it clearer. It's still pretty complicated and you have to walk through each of the steps. But in essence, if a nonprofit, despite the nominal share of an entity that it may own, if it is a general member and is really running the show there and makes all the management decisions and things like that, then it has to consolidate that entity into its books regardless. There's some exceptions here. If the other limited partners have kick-out rights or participating rights, which I've defined on this next page, basically if they have the ability to dissolve the partnership or remove the general partner, the nonprofit, then you don't have to follow these. But really, again, just know in your head, what you should do is spot issues here. If you have a situation like this where your nonprofit owns a piece of a for-profit entity, you should be looking into this, or you should be talking to us, your accountants, whoever, to make sure that you understand what the ramifications are, because it can have huge ramifications, as we just lived through with a client of ours this year. If a nonprofit is a limited partner, not a general partner, so general means you have management decisions, limited partner is you're generally an investor, which directly or indirectly owns more than 50% of that limited partnership's kick-out rights through voting interest or otherwise, then that would have to be consolidated also. So again, just have a red light go off in your heads. If you're a nonprofit that owns a piece of a for-profit, make sure you look closely at the rules to make sure you're not missing a consolidation issue. Yes?
So Diana O'Neill asks, is there any situation where in-kind donations would be considered inventory or asset on the balance sheet? I don't know how far back that goes, I'm sorry.
It goes back to inventory, but the answer is yes. So when you have a thrift shop type arrangement, and nonprofits can make a lot of money off of that, you receive donated goods, let's say it's furniture or clothing or something like that, you ascribe a value to it, you put it on your books at the fair value of those goods at the date of donation. You, at the thrift shop, really have no cost here. You have a cost on your books, but it's a cash-free cost. So you can generate a lot of cash flow when you sell that item. Say you get a couch for $1,000 that it's worth, and you sell it for $500. You're getting $500 in the nonprofit's pocket. But you would have to write it down to that $500, which is the then market value that you're selling it at, the net realizable value, the sales price. So yes, donations in kind can sit as assets on your balance sheet until they're sold or otherwise disposed of. So back to the nonprofit consolidation. There's another proposed ASU out there that would add different clarifying aspects to this because it is pretty complicated. Consolidation rules are complicated for any entity. And for-profits have this variable interest entity, VIE, guidance that's out there that's literally impossible to interpret. And nonprofits are generally exempt from that. That's why they issued this own standards update to really clarify what nonprofits have to do when they own a part of a for-profit entity. Early adoption here is permitted. But again, it affects the year we're standing in now. So now we're getting into some of the updates that don't affect us just yet, but they will very shortly. And this is the big one, the mother of all ASUs for nonprofits, ASU 2016-14. It affects 12/31/18 and June 30/19, really fiscal 19 year-end entities. So this is something you should really start thinking about now, getting yourself prepared for now. Make sure you have systems and processes in place for now as this becomes a reality. And early adoption is permitted for really all areas, but there are some caveats that I won't go into here. Some of it, early adoption would have to be for everything. Some you can piecemeal. It's a bit complicated. First, net asset classification. So right now, nonprofits present their net assets in three forms: unrestricted, temporarily restricted, and permanently restricted, right? Well, the FASB and a lot of other people thought that was a little bit too confusing. The lines are blurry there. It's hard to interpret. And we should go to just a two classification system, which they did: net assets with and net assets without donor restrictions. Either of these classifications can be further disaggregated. So you can have restricted net assets for various different purposes. You can break that on your financial statements and show it. You can disclose that. You really should disclose that. Describe the nature of the different restrictions there. So this isn't a huge change. It really would just simplify the financial statements a bit. The angle that the FASB is coming from for a lot of these is that it's really hard for the layperson to understand a nonprofit's financial statements. And we tend to agree in certain cases, especially when you're dealing with restrictions. You know, the pledge example, if I get a $5 million pledge today that I'm receiving over time, I have to book the whole $5 million now and show it as restricted. They're trying to clarify and simplify a lot of these different situations. So the disclosures will describe the nature and extent of the restrictions and if there's any board designations. So the board can take unrestricted net assets and designate them for a specific purpose. Those will still be without restriction. You'll just explain the designations in the financial statements. Hopefully this doesn't apply to anybody in the room either, but some endowment funds may be underwater, meaning the value now is less than it was when it was received, less than the corpus. So if someone gives you $1 million and you invest it poorly and it's down to $800,000, it's an underwater endowment. There's additional disclosures and new disclosures that are required for that. And the IRS will eventually need to revise its Form 990 to match the new GAAP standards. The IRS and the FASB are really not connected in any way except that they try to present similar information. The IRS, has been decimated with budget cuts, so we'll see if and when they ever actually get around to doing that. The next set, just gonna grab water quick. Sorry, everybody. Much better. The next set of disclosures deal with liquidity and availability of resources. This will require a nonprofit to explain in its financial statements how it manages its liquid available resources and liquidity risk. So what does that really mean? Basically, kind of going back to what I said about going concern, you should present, will have to present in quantitative and qualitative form the current assets available for general expenditures in the next year for the organization. So there's tables, there's examples. That's the other thing. If you need examples of disclosures, we have them all. And I didn't want to put them in here. It would be forever and it would take way too long. But a classified balance sheet now, everyone's not doing that. Classified balance sheet breaks out your assets and liabilities between current and long-term portions. It's not a requirement. It's still not a requirement. But we strongly recommend that because it really makes it a lot clearer to anybody looking at your financial statements, the liquidity risk that is involved. And so doing that in and of itself will satisfy a lot of the requirements here. You have to segregate assets whose use are limited, and financial assets not available due to different restrictions, designations, and other requirements would be carved out from that available for current use type classification. There's an update to expenses and how expenses need to be reported. We recommended forever to all of our clients that they present a separate statement of functional expenses that shows not just how dollars are spent from a functional standpoint, functional meaning what's program, what's admin, what's fundraising, but also a natural classification. So is it salaries, is it rent, is it supplies, straight down the line. So in the past, the only requirement was that the functional presentation be there. The new requirement will be that you have to show both. So really, if you've always been supplying a statement of functional expenses, you're already there. If you haven't, you probably have been kind of doing it behind the scenes anyway to build up to those functional totals. That will just have to be a requirement that's now in the financial statements. Some nonprofits can kind of blend them together. If you're like a grant maker and you don't have a significant list of expenses, if your main program is just giving out money, once you receive it, it could be easier. But still, I think this is good for the field, for the industry. Makes it clear to see what you're really spending your money on. For those organizations that actually have investments, and hopefully you all do, there are some changes to how you have to account for and present investment return. So this now requires the net presentation of investment expenses against investment revenues. So if you have revenues, dividends, interests, holding gains on a portfolio, you also have investment expenses. The fund manager fee, for instance, would be netted against that to show on one line on the statement of activities. In the past, those related expenses would flow through your separate expenses, so they'd be in two spots. Really no net impact dollars-wise. They're just trying to net the investment return together. There's no longer any required disclosures to show the components of your investment income. In the past, you had to present how much was from interest and dividends, how much was from holding gains and losses, how much was from whatever other impairments may have taken place. Now you don't have to do that. You just show it in the statement of activities, and you're set. Does anybody have any questions about those?
All these adjustments that you're talking about are strictly just for the annual financial statement. You don't have to do this for your monthly reports, right? I mean, for your annual report, right?
Yeah, generally when you're talking about GAAP, you're really dealing with someone like us coming in and giving you a clean audit opinion. So we tell our clients GAAP is good. It's a useful presentation. You should implement aspects of it into your daily lives, your monthly board reporting, but it's by no means a requirement. As long as it's clean at the end of the year for people like us who come in and turn your place upside down for a month, then you should be fine, yeah. And a lot of this really is disclosure requirements too, which you generally don't provide notes, disclosures, or anything like that to the financial statements on an interim basis.
A lot of the funding agencies, getting back to the classified balance sheet, a lot of the funding agencies are for example, on the CFR or some reports to other state agencies where you have to attach the financial statement. They're asking the question, do you have a classified balance sheet? Just wanted to point that out to you.
Yeah, it's been a best practice. Everyone doesn't always follow the best practice though. Now I really think even stronger than ever that you should be doing that. Any other questions? Because this is really the main, and by the way, this took probably 5 years for the FASB to start the process to get it to where we are today. It's been a long time coming. Along the same lines, these are updates that will affect 12/31/19 and fiscal year 20 year end, so it's a little bit out. But again, you should be aware of these. The first one is really major. It's not as huge yet in the nonprofit world, but anyone that you know that works at a publicly traded company, I'd be surprised if they're not complaining about RevRec 606. It's really changing the way revenue recognition has been done for forever. And then there's a couple of changes to how the statement of cash flows should be presented and some clarifications there. So we'll go over RevRec really quickly, only because it probably doesn't affect everybody in this room all that much. First, really most importantly, it establishes a single principles-based revenue standard. And you're supposed to recognize revenue to depict the transfer of promised goods or services to customers, blah, 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 blah. You can read this at your own leisure. What's important here on the next page, there will be new disclosure requirements, but a new ASU, a new standards update, is expected in early 2018 that will apply this to nonprofits. So this was built for the SEC, the public world. It's turning their world upside down. That's why it doesn't take effect for quite some time. But the nonprofits really weren't implemented within this ASU. So expect that in early 2018, next year at this update, and look at our social media, everything. We'll blast it out when that comes down so that you can see the true impact. And the FASB here is trying to clarify how to account for government grants and contracts. Are they contributions? Are they something else? How to account for conditions versus restrictions. Do I recognize revenue now? Have I earned it? Or is it all restricted? And then conditional versus unconditional. So nonprofit really isn't the most important aspect of what the FASB does as far as it's concerned. So we'll get our own standards in a year or so. A couple of points here in cash flow statements. The first one, ASU 2016-15, just clarified 8 specific types of transactions or situations that affect the cash flows. And those are laid out here. And then 2016-18 requires that the statement of cash flow, so the statement of cash flow really rolls forward your cash balance, right? It started at this was all the activity that came from operations, from investments, from financing, and this is the ending number. What this new ASU is saying is that restricted cash will have to factor into that, instead of it just being one of the lines that gets swinged out or swung out during the course of the year. So again, not a really huge deal. But it is definitely something different that you'll see in your financial statements. Realistically, it creates more work for your auditors than it does for you, probably. We'll skip through this here. There's some updates that I know hopefully we're all retired by 2020 and 2021. I know it's my goal. Ken? So this is far away, but a significant change. Start to become familiarized with this. This one you've probably heard about. It's leases, accounting for leases. So most of you have some form of leases. Office space being the biggest one. So in the past, what did you do with those leases? You expensed them, straight lined them if you were clever or if you thought it was necessary, but really you expense those over the course of time, over the life of the lease. What will change significantly is that you will now recognize an asset as if it's a capital lease or long-term leases, value that asset, put it on your books, record a corresponding liability for the obligation. So it's based on this premise that a lease, quote, conveys the right to use an asset for a period of time in exchange for consideration and therefore creates an asset and a liability. It makes sense logically, it just makes our lives a lot more difficult. So it's going to require that lease assets with terms of more than 12 months to recognize the asset and the liability. The ASU defines what a finance lease, sort of like a capital lease is now, versus an operating lease. There's definitions in there. It will require different disclosures than you have now. It will require some calculations and fair valuing and all these other crazy finance topics that are really difficult, and we're really expecting more guidance on this from FASB, especially as it relates to donated space, because that's not included in there. What do we do with that? So thankfully, this is quite some time away, being 12/31/20, but we will have time to really get our feet under us for this one. We have some standards here. Again, this doesn't really apply to very many of you in this room. 12/31/21 and fiscal 2022 year ends. I know it's so far out. But this deals with credit losses, measurement of credit losses on financial instruments. So it will affect everyone, I should say, in that it affects how you account for bad debts and the allowance for bad debts on receivables, accounts receivable, namely for all of you. But if you're a lending institution that gives out loans and things like that, it's even more important. But the existing standard is an incurred loss impairment methodology. So when you become aware of something being a bad debt, you generally record it. You may set up some sort of reserve. What the standard will change to is that you have to estimate potential future losses now, even on a good customer receivable, and plan for that and record that now. So it's making the bad debt recognition a little bit more aggressive, a little bit more complicated based on historical data and things like that. I'll skip through this because we're running low on time. This is just a very, 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 very small sample of what's actually out there and what's changed. Thankfully, you're all or mostly all presumably nonprofits here. So a lot of these changes that come down from FASB don't apply to you. You know, stock-based compensation, stock options, you're not dealing with anything like that, but there's a change on that every 6 months, it seems. But if your organization has any of the following, be forewarned, there are some changes that are out there. You can ask us now, later, whenever, and we'll be happy to walk you through. But if you have goodwill, generally when you acquire a business for more than its value at the time you acquire it, you'd have goodwill. There's some changes there. If you have a defined benefit plan, there's some presentation changes in how you reflect the expenses on that plan and how you disclose that. If you have any business combinations, if you have deferred income taxes, maybe you have significant unrelated business income tax or something like that, that would give rise there. There's some changes. Financial derivatives, we'd have to look up any question you have. That's the most complicated area and probably doesn't affect anyone here. And extraordinary items is a concept that they're really doing away with. So if you have some significant loss, one-time weird freak thing, you used to kind of show that as a separate line in the financial statements. FASB is eliminating that ability there. Helpful hints, remember, it's your responsibility to comply with GAAP. As auditors, we hear it all the time that, well, it's us. We come in and we clean the place up. It's really not what we're supposed to be doing. I know it looks like that and feels like that a lot of times, but really, it's management's responsibility to give us a clean set of books in conformance with GAAP, new GAAP, old GAAP, all of it. Many of these issues are not black and white. They do require judgment calls. That's why I say reach out to us or your auditors, whoever, to help walk you through some of these more complicated aspects. It requires interpretation. It requires reading contracts and things like that that may not be a part of your daily life that we do more frequently. Don't rely on us to find every instance of non-compliance. Remember, we as auditors, when we are auditors to you, we use materiality, so we can't audit everything, otherwise we'd be living in your office and you wouldn't like that very much. So if there's very, very, very small, very immaterial items that we're talking about that changed, you could probably not follow it, and it's not a big deal. No one would know. It's not even like a shady type thing. It's just that whenever you're dealing with disclosures and required information in financial statements, materiality is important. Don't worry about nickels and dimes here. Make sure you're getting the big aspects of everything correct. Regularly visit our website. We publish information on all these accounting changes as they're happening. So check out our website, check out our social media outlets, Facebook, Twitter, I don't know. What else do we have? Instagram, Snapchat. Do we have MySpace anymore? I don't know. I don't do any of it. As well, so we update you on GAAP, we update you on funding source changes. You know, if you're getting money from OMH, OPW, HUD, special ed, if you're a religious organization, there's all different aspects of nonprofit accounting and other trends that affect you that we publish and put out there. And like I said, use us as a resource. We subscribe to a really expensive and fancy resource library that gives us sample disclosures and helps us prepare everything when we do your audits. If you need that help, we're more than willing to provide it. Thank you all. That's me with more hair about 10 years ago. The contributors here, I want to give them credit. Tanya Quigley, sitting over there. Sean Wilkinson, sitting over there. They fed me this information, and they're the ones that can answer the detailed questions. I'm just a pretty face. Any other questions from anybody? All right, thank you.